And all we're really saying is when I'm investing money in the market, that the market goes up and down, that things happen. And if the market is going down, a lot of people feel like, oh, ooh, I feel heartburn, I feel anxious, I don't know, I can't sleep at night, I need to sell everything. Well, we've technically sold low, right? Like, so whatever the prices we bought it at was higher, and then the stock started tanking, so we sold it there. Well, if you buy high and sell low, you can see how that is not a winning strategy. The reality is I need to have an investment strategy that removes emotion, and rebalancing is that approach. And so the idea is I choose an asset allocation that works for me. And there are hundreds of them, but you could do the permanent portfolio, which is like, hey, I have a fourth of my investments in gold, I have a fourth of my investments in the stock market, I have a fourth of my investments in cash, and I have a fourth of my investments in treasuries. All right, cool. I know that at any given economic climate, one of those four is not going to perform as well as it normally does, right? I just know that because that's how the economic climates are. If the stock market is performing well, that means we're in a time of economic growth, which means that gold is probably not performing well, cash is probably not performing well, but you're okay with that because you have 25% of your allocations in each of those buckets. Well, what happens when the market isn't doing well? Well, generally speaking, if the market is not doing well, that probably means that interest rates are up, that we're kind of in a rough environment. If we're sort of in a rough environment, that may mean that another one of my three quadrants is doing much better. Maybe interest rates are up, and that is part of things that's driving us down into the recession because we were coming from super high inflation and a bunch of economic growth and everything was kind of crazy. Well, that means that the 25% of my bucket that is in long-term bonds, that is doing really well because interest rates are up. So that portion is outperforming the stock market, right? Like that's reasonable.